Inflation has come down. It's come down as we expected. But we have still got some way to go.
No change. The Federal Reserve holding rates steady in the range of 5.25% to 5.5%, as officials still see 3 rate cuts this year.
At the beginning of the year, market trends were looking quite exhausted. The bond market had priced in a very aggressive Fed pivot, with several rate cuts expected for 2024. And equity gains were really concentrated in the Magnificent Seven stocks in the United States. And this led us to a neutral stance in equities and bonds. But where have we got to now?
We can hold bank rate for quite some time, and the financial markets will already be easing on expectations of future cuts.
The challenge faced by equity markets is that very concentrated performance has left the market looking lopsided. Equity markets have broken to new highs, but a look under the surface shows that valuations outside of the US and further down the capitalization spectrum are still very attractive. Even the Magnificent Seven stocks have delivered corporate earnings to underpin their valuations. We are a long way from the 1990s and the internet bubble we saw then, when investors typically price stocks off price to clicks in the absence of corporate earnings.
This moment of AI mania and tech's rally, it has nothing on the dot-com bubble, but it doesn't mean that Wall Street isn't getting a little nervous.
I am prone to 1990s nostalgia, but actually the conditions today are very different, and to us equity markets do not look expensive.
Japan's central bank has made a much-anticipated change in course. It has finally abandoned its negative interest rate policy and raised rates for the first time in 17 years.
As weakening demand and economic uncertainties loom, factories around the world are contending with declining orders and contraction.
We're now responding to cheaper valuations outside of the United States by extending our equity exposure beyond the US into Japan, Europe, and emerging markets. We've liked Japan for some time due to its stimulative monetary policy and a cultural shift towards better capital allocation and shareholder return. We believe that Europe and emerging markets should benefit from a global manufacturing recovery. And the fact that central banks in the US and Europe will start to ease policy is also helpful to valuations. Of course, a number of emerging economies have already started to loosen monetary policy. So all in all, we're positive on equities. As the year progresses, there may be more challenging times depending on whether central banks meet their inflation targets, but we see a window of opportunity here to generate return. Turning to bonds, ongoing resilience in US economic data has led to a repricing of Fed rate expectations, which now look much more reasonable and aligned with our view of a soft landing. We're still retaining our neutral stance, however, because we do not expect an imminent recession in the United States from these levels of employment. Our exposure to fixed income remains focused on generating income rather than looking for significant price appreciation or negative correlation to equities. We like gold because it benefits from looser monetary policy and also has the advantage of offering protection if inflation proves to be stickier than expected.
President Putin has hailed his victory in Russia's presidential election.
Lastly, I'd like to say a word about political risk. Geopolitical tension is an unfortunate constant, and there's a lot of talk about all the political elections this year. Now, thinking about geopolitical risk first, the challenge is that geopolitical events by their very nature are very difficult to predict. And our only defence really is to ensure that we are diversified by asset class and by geography, and that from a corporate perspective, we're on top of the resilience of our global supply chains. The timing of elections is obviously known, but we can overemphasise their importance. There's already been a major shift in the political consensus towards greater fiscal intervention and protectionism, which is likely to stay in place irrespective of electoral outcomes. We discussed this a lot as part of our 3D reset, and what it means is that it leads to deterioration in the growth and inflation trade-off, which means it's very unlikely that we're going to return to the world of zero rates that was in place in the last decade. We also need to reassess sovereign risks as bond market investors react to higher levels of fiscal spending, which is a major difference with the 1990s, when fiscal rectitude led to a reduction in bond market risks. All in all, politics matters, but they tend to play out over months and years rather than days.